This is Evercore's Flow of Funds with Glenn Schorr. Sharp perspective on private markets, wealth, and the forces driving change.
Hi, everybody. Welcome to Flow of Funds here at Evercore with Glenn Schorr. I'm happy to have Steve Eisman with me today. Steve has had a really big impact on my career at different points. I love the way he processes information. I love the way he sees the forest through the trees. And of course, I love the way he speaks his mind at all times. You cannot control him. I'm sure you know Steve from his days of analyzing and identifying the collapse of the U.S. housing market and the global financial crisis. And if you don't know, you should know, he has this amazing podcast right now called The Real Eisman Playbook, which you should subscribe and listen to. It's truly excellent. So the goal, I like to talk about the goal of today's conversation. The goal is to use a couple of points in time that I remember from Steve's career and some historical big calls that he's made, what he was thinking, what he saw then that the world didn't, and then try to bring it into today's reality of everything related to direct lending and private credit and what he thinks is the same and what he thinks is different. And as always, Steve's like, go ahead, ask, no prep. We'll talk off the mind, and it'll be a little unfiltered, which is the best way to consume Steve Eisman. So anyway, I'm not the hugest fan of fluff and history, but in this case, we're going to use a couple of things from history because it actually sets the stage for today's conversation. So let's start with number one. It goes all the way back to the late 90s and then early 2000s. And I remember I was actually on the buy side when this started as a fixed income guy, like reading your research and key events. And this was a key event that got me actually transitioning to sell-side equity research, kind of inspired by your work. Oh. So it was a report you wrote in like 1997-ish, and you said Glass-Steagall is going to come down and banks are going to buy brokers and it's going to be a big deal and you should buy the brokers. So he was dead right. A ton of M&A happened actually before Glass-Steagall came down. So Steve, why don't you talk to us about why you thought that, why you're the only person on Wall Street that was saying that, how you knew it would happen, and what gave you that courage? Because that was my first real Steve Eisman 101 introduction.
Well, that takes me back. So first of all, thanks for having me.
Of course, please.
So I actually remember that report very well because it's this kind of a funny story. So I can't remember what year I actually wrote it, but it was at least, I actually wrote the report at least a year before I published it.
Interesting.
And what happened was I had this like epiphany that if Glass-Steagall comes down, there's obviously, it seemed to me, a whole bunch of these mid-sized firms like an Alex Brown, which, takes you way back.
Yes.
Will get bought out. That just seemed obvious to me. And even if they didn't all get bought out, they'll all get revalued anyway, because as soon as one of them gets bought out, everybody will assume they'll all get bought out. So I went on a tour and I met with basically every one of these mid-sized firms that I wasn't covering. And I remember the first meeting was with the CEO of Alex Brown, who amusingly, this is a guy who had worked for the CIA, and then after Alex Brown got bought out, he went back to work for the CIA. He was adamant that Alex Brown would not sell. And it turned out he sold first. So I went and basically toured all these companies, and I wrote a report, and I stuck it in a drawer. I literally took the report, I put it in my top drawer because nothing had happened yet. And I left it there. And then when it became very, very clear that the regulations were going to change, even pre-Glass-Steagall coming down, I took the report out of my drawer, I updated all the earnings stuff, and I put it out. And that's the origin of that report.
What is amazing about that is, we've known each other for 30 years or almost, and I don't know if I've told you all the pieces of this, but what's amazing is, so that report came out at the time when I was happy but underpaid, frustrated municipal bond junior portfolio manager. And I decided I got to get to the equity side. It's just cooler. It's more interesting. And I determined that lots of Wall Street research firms covered the banks, but nobody covered the brokers because no one wanted to write bad things about brokers because then you would be left out of deals or whatever, right? And so I was like, ooh, this is my entree. I went to the sell side with kind of your report idea and said, listen, this is going to happen. You should be covering the brokers. And it worked. I actually got a job.
Where'd you get a job?
At Gruntle Securities, which is no longer around.
Right, of course.
And but I convinced them, hey, you should cover the brokers and like hire me. I was an older associate because I had already had a buy side career, and I said, but this is what I want to do. And so somebody said yes. So what's interesting is that's the first time that you had a big impact on my life because I transitioned over. So that brings me to question number 2 and point number 2 in your life. So now I'm on the sell side as a junior associate and helping a woman she covered a lot of things, including the consumer finance companies. And so now this is, I got June of 98. So sometime between the second half of 98, early 99. And the analyst I was working for happened to be a big fan of a bunch of these consumer finance companies. And I knew nothing. I was brand new. I was a fixed income guy now trying to do equity research. Again, I come across a Steve Eisman report.
What did I say?
The opposite of what the analyst I was working for said.
Yeah.
You said all these companies are going to go bankrupt.
Oh.
And you had a literally $0 price target on almost all of them. And I remember going home to my wife, and I'm like, I'm in a little weird bind because I work for this firm. I work for this analyst. They were nice enough to hire me, and I knew nothing about equity research. I'm trying to learn, and I think that guy's right, but I don't even know enough about what he's saying. So anyway, why don't you just talk about what you saw? Because the whole world was a fan of these consumer finance companies, and you were screaming zero from the top of your lungs.
So because I covered specialty finance at Oppenheimer, it allowed Oppenheimer to create an entire investment banking business involving taking specialty finance companies public. It was pretty lucrative for quite a long time.
Probably until you had $0 price targets, but whatever.
Right. And, but I was always very cognizant of the fact that I have a reputation. And if it turns out these companies are going to do badly, it's really going to hurt my long-term reputation, which was very precious to me. So all the companies that we would talk about, whether it was, subprime auto, subprime mortgage, money store, securitized all their loans. That was really like the new thing back in the early 90s, which was prior to securitization. If you were a specialty finance company, you always had issues of how you're going to fund your loans. And once the securitization market came about, it was like a whole new world. And that's why that was the growth in specialty finance, was because of securitization. I found out that for $10,000, Moody's had a database on every single securitization. So I figured, just to protect myself, because I need to know what's going on, I got my firm to pay for the securitization database. At which point, Vincent Daniel came to work for me. And we eventually became partners, and we're still friends. And so Vincent was an accountant, and he became working for me as my junior analyst.
From the great school of Binghamton?
Yes,
where I went?
He was from Binghamton, correct. And I said to him, Vinny, I'm putting you in this office. I need you to create a database of all the securitizations of all the companies that we cover. Don't come out of this room until you're done. I don't want to see you until you're done. it took him months because, I mean, today, you could,
Poor Vinny.
today,
If he had
t-
Claude
today
or
you could
Chat
literally,
now.
scrape the data, bing, bang, boom, and, put it into the right form. He literally had to put in every single delinquency. And so what you would look at is you would look at, let's say, what were the prepayment speeds? What were the delinquencies in month 6 for every single securitization? And what you would want to hopefully see was that there was no underwriting deterioration. But if you saw underwriting deterioration, you were in trouble. So what we saw, it wasn't so much underwriting deterioration. What we were seeing was massive refinancing of all this paper. And unfortunately, the firms used an accounting method of gain on sale where they present valued all of the revenue up front. That was what they were required to do back then. The accounting eventually changed. So you had to make an assumption about how long the loans would last. And if the loans were lasting literally half the duration of what you assumed, you were going to have massive write-offs. So we put out a report. It was the first report of its kind on Wall Street, where we literally took the database and we put it into a report. And we showed all the data on the prepayment speeds. And we said, look, this data is very, very clear. The massive write-offs are coming. You got to get out of here. And my investment bankers were not pleased, but I didn't care because I knew this was going to happen. This was going to happen whether I was recommending the stocks or not. So I might as well be on the right side. So we downgraded the whole group.
Yeah,
and that's what happened.
I remember it well. Those are two clear cases where you were just off on your own and the rest of the coverage universe was over here. So that's two. Okay, last thing before we get to today's private credit backdrop is, of course, the great financial crisis. So I think people have read the book, seen the movie, heard your podcast. We don't have to do the whole thing. By the way, little known fact, I did make a little cameo on page 173 of the book, and I'm still
page 173.
That's what I've been told.
What was said on 173? I am unaware.
By the way, it was unbelievable, but I'm pissed that it didn't make the movie because I think it was an amazing scene. It's when you and I went to meet with the then CFO of Merrill Lynch.
Oh,
that is the largest shareholders.
That is a spectacular scene.
It was unbelievable.
Spectacular. It was me at my absolute most obnoxious.
Yes.
And there were plenty of those moments, believe me. I'm not like that anymore, ladies and gentlemen. Not even close.
Not even close. Not even close. That was peak Eisman. I loved it. I'll tell anybody the story that wants to call up. But long story short is we went to see the CFO during the most perilous times.
August of 2007. First week of August.
And you the long story short is you asked in a couple of very simple terms, about the CDO exposure on their books, and he might as well have answered what he ate for lunch that day. You threw your papers up in the air, landed in the middle of the room with all the largest shareholders and said, I'm sorry, you don't know what the blank you own. You guys are blanked. And then 5 minutes before the meeting ended, you left.
I just left.
Peak Eisman.
That was me at my worst.
The live story is even better. If anybody wants to hear it, call me. But there you go. So the interesting thing is I just want to get to, because we're trying to paint the case of you've seen the forest through the trees, and then what do you see today? So this is the last thing is so what was it? Was it more similar to the subprime consumer finance companies where it was data related? No one in the world thought housing could go down. What were you looking at that had you among a couple of people on the planet that saw this coming?
So
you and your team, Vinny.
Definitely my partners, for sure. This was not a solo show.
Yeah.
The report that you mentioned before was very, very important because all those companies actually did go bankrupt.
All of them.
And what happened was, starting in 2002, the second generation of subprime mortgage companies went public. The funny thing was that many of them were run by the same guys who ran the first generation. They just changed the names to protect the innocent, so to speak. So, as early as 2002, me, Vincent, Porter, we all were thinking, we saw this play before. It's a play in 3 acts. Act 3 is a tragedy. Call me when Act 3 starts. So we, sometimes you see things because you're actually looking for them. So we were looking for them. And, we subscribed to the same Moody's database. And it's not like I had information that nobody else had. That Moody's database by then was like Moses with the tablets. Every single month, that data came out over 2 days, mid-month. The entire securitization world would basically stop for 2 days. They would do like a deep dive in terms of the data, and then they would start trading again. So the data was bad. It just kept getting worse. I think the reason why the people in the fixed income world sort of ignored it was, number one, they'd been making so much money for so many years in this paper. It was sort of unimaginable to them that things could get bad. And the other thing was that they were all just data driven. They actually didn't do any legwork. They didn't go out and figure out that the underwriting standards were really deteriorating. That was, as you know, equity people are story people. That was a story. You had to go out and talk to people. And once you realize that the underwriting standards had deteriorated that badly, all of a sudden it became quite possible that housing prices could go down. I remember we had a meeting with the head of asset-backed research at Bear Stearns of blessed memory. And I remember he said, he really believed, he said it in the room, that the housing prices in the United States don't go down on a national basis. And I said to him, dude, is that like a law of physics? And he literally thought it was kind of like a law of physics. It was unimaginable. But once you realize how bad the underwriting had gotten, you realize that it could happen. And my gong, what was the gong other than the data? The gong was when the Sandlers sold Golden West in May of 2000, and I think it was May 2006, or it might have been May of 2007. I don't remember exactly. The Sandlers were these iconic lenders. Fun fact, the Sandlers knew me when I was in diapers because my father's best friend was Herb Sandler's older brother. Okay. So, when I got into the business, I got friendly with them. And I realized that if the Sandlers are selling, it's over. It's over. And that was my gong.
It's interesting. Okay. So we're going to transition to today's environment.
Oh, something's going on in today's environment?
And what I've heard is 2 different things. Some of it, there's behavioral, some of it is digging, some of it is data.
Right.
And underwriting. So all those things will come up through this conversation. So I'm gonna start with a purposely provocative statement.
Please
Question. So we haven't really had a credit cycle since the financial crisis in 08.
It's 17 years.
Which is unbelievable.
Unbelievable.
If you listen to bank earnings, you will hear about a strong enough consumer, strong enough corporate balance sheets. Mm-hmm. If you look at these direct lending private credit portfolios, you will see companies that have 150 to 250 million of EBITDA, good margins,
right?
Interest rate coverage ratios of 1.5 to 2 times, 1 turn of leverage when the banks had 20, 30, and 40 times leverage back then.
40.
So
it was 40.
I ask you, opening question, what's all the fuss about if there's all these good companies?
Well, it's not a leverage story.
Okay.
This is not a leverage story. I mean, it's possible there might be that there's some stuff in the life insurance sector with hidden leverage, which is very, very hard to figure out.
Yes.
And I actually had on my podcast,
I listened to
about it.
It's
and
great.
And it was very interesting. I'm not 100% sure he's all right. He's 100% right, but he certainly raised some very important issues about, how life insurance companies reinsure their books internally and whether that creates hidden leverage. It's an important point.
Yep.
But this is not a leverage story, and nor do I think, despite the fact that the banks do lend to private credit, for their leverage. And I think the data that I saw was that there's about 300 billion of this loans to private credit, and there's about 350 billion of unused commitments. Even if private credit gets really bad, which is certainly possible, the banks have never been this well capitalized in their history of being banks.
Right.
In the history of the United States, let us just say categorically, in the history of the United States of America, the U.S. banks have never been this well capitalized. Hard stop. I think that's a very fair statement. And we owe that, to Daniel Tarullo, who was the first vice chair of financial supervision, who every single bank cursed when he was doing it. And today they would bow down to him.
Thank goodness he did what he did.
He did what he did. So this is not a leverage story. So therefore, whatever happens, it certainly could cause a recession. It's not going to cause a systemic meltdown. So let's put that on the table to begin with. I think what we don't know is, we do know that private credit has a very large exposure to software. That we do know. We know that it's at least 25%. There was an interesting article in the journal about classification, so maybe it's more. Let's say it's 30. It's certainly large. Now, these are all pretty good companies. The problem is that about 11, 12% of the debt's going to get refinanced next year, and another 20% is going to be refinanced the year after that. And here's the problem. These companies were all bought out in 2018 to 2022.
Probably at high prices.
Multiples were more than double where they are today. Now, what's happened to the software sector, which you can't blame private equity for this because nobody knew about this in 2018 to 2022, is that AI has created a risk to software that has never existed before. And the risk is that they create much cheaper software. Now, how much inroads AI software is going to make into the software industry is unknown at this point. It's a lot more complicated to be a software company than to just make software. I mean, there's a whole bunch of different things you got to do to actually be a software company. Making the software in some ways is the easiest part. However, the SaaS model for software is kind of like the asset management model in terms of how you would model it,
right.
Which is you make an estimate about how many seats you're going to grow. You take an average for the quarter and you multiply that by the average price that you had last quarter, and that's revenue, which is why software stocks used to sell at such huge multiples, because they're so easy to model. And
recurring.
It's recurring, and because the subscription is like a monthly or a quarterly service, it makes it kind of easier to raise prices because it's kind of subtle. So every year you raise the average price 5%, 7%, whatever it is, and you move on. I think that the days of raising price are probably over. And then the question becomes, what's going to happen to seats? I don't know. Nobody knows. I do know that for the first time in decades, software stocks sell at significantly lower multiples than the market, whereas they used to always sell at significantly higher multiples than the market. So from a forget about private credit, from a private equity perspective, all the companies that were bought between 2018 and 2022 are worth less than half. I think that's a very fair statement. What private equity is going to do about that? They're stuck. I don't know what you can do about that. I'd be curious what you think they can do about that.
Yeah. So to your point, if you have rolling maturities coming in from now through 2032,
right?
The BDC structure, the retail vehicles that have made a lot of these loans,
right?
They have maturities coming due. They're going to need that money, right? Because right now, if you're in net redemption 5% a quarter.
Right.
You're right now.
You need that principal back.
You're negative cash flow.
Right.
Right. So right now, you can add some leverage and draw on your credit facility to pay off some of these redemptions. But eventually, the maturities will offset the redemptions. But you need the maturities to happen.
Right.
Which means that specific structure may or may not be the one refinancing these companies.
Correct. Well, the other part about it is that, I mean, think of it this way. So software company X has got to refinance its debt in 2027.
Mm-hmm.
Company's worth half of what it was worth when the deal was done. And because the deal was done between 2018 and 2022, interest rates were significantly lower.
Correct.
So how you're going to refinance this paper, I mean, it seems to me most of the equity is probably wiped out upon the refinance.
Well, so you asked, what do I think happens? I clearly, not all software companies are
going bankrupt.
Correct.
Not even close.
There are a tremendous amount that are part of the fiber.
But the growth
fabric.
story is probably severely
I'm with
impaired.
you, and pricing is an issue also. And so my first obvious answer to your question is all the ones that are still viable businesses, which is probably most. I don't know. I'm going to have a great software expert on in 2 weeks that we'll do.
I had one on my show and I interviewed a few weeks ago. I'm going to post it in 2 weeks.
Good. I'm very much looking forward to it. So bottom line is, and by the way, this doesn't have to be any software business. Anyone that's coming up for refinancing in the direct lending market, supply, demand of capital, there's a ton of dry powder sitting in a lot of funds. Institutions are still putting tons of money into the whole space. And as we speak, these same firms that run these direct lending vehicles are raising capital for opportunistic credit funds. Institutionally.
Right. Blackstone raised one.
Correct.
Announced one today.
$10
billion.
Correct. So the answer is most viable companies will get funded. They'll just get funded at wider spreads. And so if you, let's just say.
And they have to put up more equity.
Correct. If you had 150 or 200 million of EBITDA, wider spreads and higher rates, that just might wipe out a chunk of your EBITDA, but the lender still gets paid back. That's the good scenario. It's not so good for the equity owner. And the more you eat into that cushion, they might have to put in more, but that might be the equity, but that might be the best path. Others will get to the point where it eats up too much or no one's willing to finance it, and then it becomes maybe they have to toss the keys to the lender, and the lender has to go work out and figure out what they can recover. So it might be in certain parts of the world that we have over the next couple of years a rolling restructuring environment going on. So that maybe that gets to the all right. So again, if there's only a couple $100 million in direct lending space in the wealth channel that's being redeemed, and the same couple $100 million in back leverage that you talked about, how big can loss rates be? Because it's not all
100 billion. 100 billion.
100 billion.
Yeah,
I said million.
You said million.
Billion. Yes.
I mean, look, it would seem to me if you're Blue Owl, you just got a 22% redemption notice in your biggest fund. You're a little shaken up about your business model. It just seems to me lending is going to get a little tighter. That I think is fair. How much of an impact that's going to have on the U.S. economy, I don't know. Because I actually think the most interesting story of the last 17 years, or at least one of the most interesting stories, is that every few years after during the last 17 years, something's happened. This crisis, that crisis, this war, spreads widen, oil prices go up, whatever. And somebody gets on CNBC and says, this is it. This is going to cause the recession. This is it. And it doesn't. And I think we have to have a respect for the incredible resilience and dynamism of the U.S. economy. Now, maybe what's happening in private credit and is going to cause tightening throughout the lending markets overall, and that will cause a recession? Maybe. But it's too early to make that kind of prediction.
Yeah. I'm with you. Look, there's some numbers. as these vehicles were born out, they were born in an environment that had no credit losses. So literally loss rates in these single B and double B names has been 1% or below for most of these funds. In the COVID period, it was brief, but loss rates in levered lending and high yield like this might have been 4 and 5%. And in the great financial crisis, they were like 10, 11%.
Right.
These funds yield 9%, right? These funds would be not the outcome that their investors or managers wanted, but if it wiped out the yield or part of the yield, that's not a crisis. That's a bad vintage.
Right.
Right?
Right.
So, and remember, top of the capital stack with equity below it, it takes a whole lot of loss to eat into the lender's top of the capital stack lending. So anyway, you talked about underwriting standards before, and you talked about transparency, and you talked about how you define, like, what things have you heard about today's environment that rhyme with the crisis in terms of any of that underwriting, like software?
I think what rhymes to me is that the great financial crisis a lot of it was a story of leverage. And what had happened was between 1997 and 2007, leverage in the banks tripled. Return on assets were flat, but leverage tripled. So ROEs tripled. That's just the way the math works. The problem is that the CEOs of these companies get compensated on a combination of net income and ROE, not ROA. So they all thought they were geniuses. But the line that I've used over the years is they mistook leverage for genius. What's happened in private credit is not a leverage story. It's a lack of a credit cycle story. And so you have an entire generation of private credit executives who have mistaken the lack of a credit cycle for genius. And now they're going to have a credit cycle, and we'll see who was good and who was bad. That's what's going to be very interesting.
It's a great point, because you and I were watching over these financial stocks and the traditional asset managers before any of these companies were even public on the alternative asset management side, and eventually performance dictated your success.
Right.
It's interesting. I've covered these alternative asset managers since they've gone public. And unfortunately, or fortunately, this is the first time where we're starting to talk about performance. It was just growth because, filling out.
By the way, I want to press that point for a second, because there's an interesting aspect of the growth story of private equity that nobody talks about very much, which is for institutional investors, the GFC was painful. I mean, they got their heads handed to them, and it was embarrassing because you're an institutional investor. You're supposed to know better, and you were down 40% in 2008. So the thing that's very important to institutional investors is their Sharpe ratio. That's like the thing that they care about the most. And for those of you who don't know, the Sharpe ratio is basically what's your unit of performance as compared to your unit of risk. And another way to think about it is how much return do you make given how much volatility you take? So because of the GFC, there was a lot of volatility. So I actually think that one of the reasons that private equity grew so much is because private equity has an appearance of not being volatile. The reason why it has an appearance of not being volatile is because it doesn't give you a daily price. So institutions flock to private equity because they could pretend in their minds that their Sharpe ratios were really good because private equity was not a volatile asset. Now, private equity did really well for many, many years because in an era of financial repression, if your business model is to buy a company and lever it, as long as there's no credit cycle, you're going to do well. So full respect to private equity having exactly the right strategy during the era of financial repression. What I object to is that it's not true that they're not volatile. They just don't give you a daily price.
So I have a couple things to comment.
Somebody called that volatility washing.
I remember. I'm sure some that places that's true. And in a world of declining interest rates for 30 years, I get that piece. I would say 86% of companies with 100 million or more revenues are private, and they always will be, and they're going to get financed in the private markets.
Right.
And if you want exposure to the SpaceXs and the OpenAIs and the Anthropics, you must give these companies money to manage to get access to those private markets. I would also say that they actually make the companies better in many ways, and I'll let them describe it, but they have huge teams of people that learn from the successes and mistakes of their other companies. And if you run
I grant you all of that.
Okay.
My only statement is that one of the reasons why private equity grew so much is because of this volatility thing, which is really not true.
No, I understand your point, because I think anyone should, if you're going to give money and pay higher fees and lock up your money for a longer period of time, institutional investors did want uncorrelated returns.
Right.
Deck fixed. Good. Everyone's full on board with it. And you want to outperform what you can do in the public markets that are fully liquid, or else what am I doing?
What are we doing it for?
And so I think they did that for a long period of time in private equity. Last 3 years, it has been impossible to beat the Mag 7.
Right.
And in private credit, they've done that since the existence
No
of
credit-
it.
no credit
No credit
cycle.
issues.
No credit cycle.
And now we'll see what's
Now
what.
we'll see.
Right. Okay. So I'm with you.
Okay.
Okay. I just want to hammer this point home. You said it at the beginning. There's a lot of focus on what the banks have exposure to in terms of non-depository financial institution lending, NDFI lending, and if there's a BDC that has, $20 billion of assets of equity, they might give it another $20 billion for one turn of leverage, and they'll do it at a low enough LTV, loan to value, and they sit high up such that you need to eat through tons of losses for the banks to lose much. So there's a lot of talk of systemic credit. I just want to ask point blank.
I'm
not worried about
banks.
Me neither.
Just not. I've been worried about the banks basically since Tarullo took over.
Good. And you're right.
Who I met. I met
Recent.
Tarullo a couple of times.
Okay.
He's an interesting guy.
Yep. Well, he did right by the system, because if all these private credit loans that people have such a fuss about right now were in the banks,
Right.
we'd have a bigger problem right now.
He's the unsung hero
Yeah.
post-crisis era.
So I'm curious to get your reaction to this statement. I just read this the other day, and I was like, I can't wait to ask Steve that. In 2008, financial crisis time, the mortgage market was 60% of debt outstanding. Today, private credit's like 3%. Again.
Well, that's actually not. I saw your report. I saw the statistic. I don't think that's a fair statement, because included in that is Fannie and Freddie and jumbo. The part that was the real problem was the $600 billion that was originated in 2006 and $600 billion that was originated in 2007 subprime. Then that stuff got put into CDOs, 10 times the size, and that was the problem. But the 63 is not.
Okay.
I don't think that's a fair comparison.
Fair. Wanted to get your response. As you just alluded to, the big institutional LPs are eyes wide open, invest over cycles, and when there's a bad vintage, they actually invest plenty in the next vintage.
Right.
Because bad vintages leave the ground for good vintages. And if you look back, the 2009 and 2010 private equity vintages were the best returning of all time.
No, interesting.
Clean up other people's messes.
Right, sure.
I'm curious if you think that will be the case here, and if the presence of retail money, wealth channel money in private credit changes the rules a little bit.
I haven't given that much thought. I just think we're so early in the credit cycle that I'm just more focused on that right now.
Okay. I'm going to give you a chance for like a closing remark on what people should take away. We went through a couple of points in your time where you saw the forest through the trees and the market just was not getting it. All three times the market came your way. through your digging, your team's digging, and your ability to see that forest through the trees. Is there a forest through the trees here? Or are we talking just about bad vintages in a piece of the direct lending market?
I think it's just too early to know. I just don't know how bad this is going to get. I read some people who are pontificating that it's a disaster already and it's going to take the economy down. And the data doesn't support that at this point.
Yeah.
So I just think we have to wait and see how it unfolds. I do think that private equity investments in these software companies, they'll never get out for 90% of them, because the public multiples have been cut by more than half. There's nothing you can do about that.
It's interesting. What would you think of the idea of merge them?
Could merge them, but you still got the same valuation problem.
You have the same valuation.
Now, maybe if you merge them and then there's AI in there and you could show growth again, there'll be a few that'll show that. But I think the overwhelming majority will be underwater.
Yes, it is interesting because these companies, right. I think it's important to note that private equity is usually later stage in a company's development. We're not talking about venture capital. Mm-hmm. These are usually later stage companies. So they have today EBITDA, margins, and some growths, maybe even some inflation escalation in current contracts. To your point, a lot of those things start to unwind with the advent of AI for some companies. So EBITDA can grow in. It's an interesting.
But it doesn't matter. Assuming unless the multiples come back, the multiples are the multiples. There's nothing you can do about it. You bought a company at 25 times earnings, and and now the valuation is 12.
What do you think of this idea? You were right a lot when you were on the buy side. Once in a while, you'd get a stock wrong, and you'd sell it
all the time.
Sell it below the price you bought it.
Right.
Could they sell these things at the price they
could?
Below?
But there could be no return for their investors.
Yeah. All right. Well, to be continued. We're going to do another part of this. Steve, love having you on. Thanks for doing this. Thank you, everybody.
Thank you.
You've been listening to Evercore's Flow of Funds with your host, Glenn Schorr. Be sure to subscribe wherever you get your podcasts. The views and opinions expressed on this program are for informational purposes only and do not constitute investment advice or a recommendation to buy or sell any securities. This program is brought to you by Evercore Group, LLC, a member of FINRA and SIPC. To learn more about Evercore's research and investment banking businesses, visit evercore.com. Thank you for listening.